Let's talk about journal entries and T accounts. A journal entry is an entry into the accounting record that reflects the analysis of the effects of a single transaction, and it looks like this. We'll debit, name of account debited with the amount, and credit, name of account credited with amount. For good form, debit entries always come before credit entries, and credit entries are indented, and we never write any negative numbers. The T account is a graphical representation, and it looks like a giant T. So we have asset, liability, and shareholders' equity accounts. Note that for the balance sheet equation, asset is on the left-hand side of the balance sheet equation, and liabilities and shareholders' equity are on the right-hand side. Since the asset is on the left-hand side, its beginning balance is on the left-hand side as well. Liabilities and shareholders' equity are on the right-hand side, so their beginning balances are on the right-hand side. Any increases to the assets get put on the left-hand side of the big T, whereas any increases to liabilities and shareholders' equity account gets put on the right-hand side of the big T. Any decreases to the asset gets put on the right-hand side of the T account, whereas any decreases to the liabilities and shareholders' equity gets put on the left-hand side of the T account. And we have the ending balance for assets on the left-hand side and ending balances for liabilities and shareholders' equity on the right-hand side in general. Debit means to the left, so the left-hand side will always be called debit, and credit means to the right. So anything to the right is going to be a credit entry. And notice this holds true regardless of whether something is an asset, a liability, or a shareholder's equity. Let's work on an example together. BiteSizeQ&A company issues common stock in exchange for $20,000 of cash. So what happened? Cash went up by $20,000, and now we have $20,000 of common stock outstanding. Next, we can think about the accounting equation. Remember, assets equals to liability plus shareholders' equity. So for assets, we have $20,000 of cash, and under equity, we have $20,000 of common stock. So $20,000 on the left-hand side of the equation equals $20,000 on the right-hand side of the equation, and everything remains in balance. Let's think about the journal entries. Since cash went up by $20,000, we'll debit cash by $20,000, and we have common stock going up by $20,000 as well, so we'll credit common stock. Next, let's think about T accounts. T accounts are graphical representations, and let's start with cash. Since cash is an asset, its beginning balance will be on the left-hand side, and let's assume that it is 0. In contrast, common stock is a shareholder's equity account, so its beginning balance will be on the right-hand side, and let's assume that it's 0 as well. When the company issues common stock in exchange for $20,000 of cash, cash goes up, so $20,000 gets put on the left-hand side of the cash T account. Common stock goes up by $20,000 as well, so we put $20,000 on the right-hand side of the T account for common stock. Notice that the left-hand side equals to the right-hand side, or debits equals to credits, so everything remains in balance. And now you know all about journal entries and T accounts.